So from my perspective, I'd still say the backdrop on trade is probably the biggest issue. This is the one that's most disruptive to the global supply chain. It's the issue that's had the biggest impact so far on the slowdown in manufacturing. And it's also the one that the Fed is looking now to respond to. So if I got to pick one, I'm going to go with trade as still being the biggest issue right now on the table.
All right, and we're going to go with your Mike and Michael, your Michael. So Michael, he says it's trade. Do you agree on that? And again, the reason why we pose the question this way is to look at what it would take for the markets to be able to climb to these new highs and then higher from here. What do you think it would be?
So I think that trade is the biggest issue right now. If you look at the way economic expansions end three ways, the central banks tighten too aggressively like the Fed. Well, it looks like they're going to ease. Some type of government policy mistake like trade. And then lastly, an exogenous factor, perhaps like the Saudi situation that happened over the weekend, although I don't think that's big enough. So from my perspective, I would agree with Mike that I think that trade is the biggest issue or risk facing markets right now. And I think what's interesting about that is the market's telling you that. So in both May and August, when the trade discussions kind of went off the rails, you saw the markets react negatively. And when we get signs of positive sentiment, you see that markets respond more favorably as they have in the last week or so.
So, Michael Arone, you just mentioned the three things that cause economic cycles to turn. The Fed tightens too aggressively. You cite the fact that they've been cutting at least, and they're expected to. But they had been tightening, and a lot of people thought too much too quickly. Government makes a mistake. Trade, arguably, you've got that. Third, arguably, you've got an exogenous shock here, though you think it's not quite as monumental as to tip the global economy. But what are the odds that the economic cycle is in the last innings of this global expansion, and particularly expansion in the U.S.?
Well, if we look at the data last week, it wouldn't suggest to me that an economic recession is anywhere on the horizon. Small business optimism, consumer sentiment, both were positive. Retail sales came in pretty positively. Inflation came in above expectations. So from my perspective, what's really interesting is without the U.S.-China trade conflict, I'm not even sure we'd be talking about the Fed because I don't think the Fed would be reducing rates at all.
Mike, what about you? When it comes to expectations for the rest of the year, we've had this big move upwards in interest rates just in the last week or so. Does that make future cuts less likely?
No, I don't think so. I think what the Fed is going to have to do, and I think Michael laid it out pretty well, I think if we had some progress in the trade front, it would probably ease the pressure on the Fed to go out and cut rates. But as long as we're going to keep this as a backdrop, as long as it's going to be the overhang of trade, and now we complicate that further with the spike in energy prices, this keeps enough friction in the global economy that it keeps the Fed in place. So we're looking for this week about 25 basis points in the Fed. We also think that over the course of the next, say, 12 to 18 months, we expect cumulatively about 125 basis points cuts by the Fed.
Wow.
So our view here is that the Fed is now looking to extend this cycle, and one way to do it is through a policy.
Yeah, 1.25 points of cuts almost sounds like a financial crisis, Mike. But to what you said about the oil spike and the way that that'll play out, then you're on the team that says it's likely to be dovish for the Fed, not hawkish through the price channel.
It is. First of all, remember that when we get these one-time price shocks, the Fed look through those and they look at what the economic impact is. So, yeah, there may be a near-term spike in terms of finished goods inflation, but that's transitory, and the Fed really looks through and what it does to long-term consumption. Now, by the way, I want to be clear here about 125 basis points. We're not looking for a financial crisis. We're not looking for a recession. What we are looking, though, is that the fact that we've seen inflation has frustratingly been below the Fed's target of 2%. And that growth is now once again below trend. The Fed wants to make sure that this expansion doesn't fall into jeopardy, that we don't wind up seeing monetary policy wind up becoming a problem rather than a solution. So I think that's why you're going to see the Fed continue to ease policy balance of this year into next year as well. Okay.